CA Cotha S. Srinivas, respected CAB Rajashekharan, Chairman of Vellore Branch of SIRC of ICI, CA Manju Bhashani, Secretary of Pondicherry Branch of SIRC of ICI, CA Satish Kumar, Vice Chairman, Pondicherry Branch of SIRC, CA Taniki Velan, Secretary of Vellore Branch of SIRC of ICI, and respected members of Pondicherry Branch and Vellore Branch and other members of ICI, dear office bearers of Pondicherry and Vellore Branch of ICI, and other distinguished participants. Happy evening to all. We are all delighted to receive you for the seminar on TDS under Section 195 and Form 15CA and Form 15CB. Section 195, which deals with the TDS on payments to NRI. It is an area prone to litigation and ambiguity always exists as to whether TDS shall be applicable or not for each and every type of payment made to NRI. We have seen many chartered accountants having the habit of deducting tax, even if there is a small iota of doubt as to its applicability, and avoiding taking risks as a precautionary measure. Similarly, many issues are associated with regard to certification of Form 15CA and Form 15CB. We have seen cases where bankers insisting on issuance of Form 15CA and 15CB, even if they are not applicable, citing safety reasons. It is in this context we thought fit of having this seminar to enable the members to enrich themselves on a complex subject from our learned speaker, CA Cotha Srinivas. We are immensely pleased to extend our heartiest welcome on behalf of Pondicherry and Vellore branches of SIRC of ICI to Speaker CA Cotha S. Srinivas of Bangalore. We are thankful to him for having readily accepting our request at short notice. He is very familiar to our Pondicherry branch and he has very rich experience and is specializing in the fields of non-resident NRI taxation, FTAs, FEMA and other matters. He is known for lively presentation of the topics, and without doubt, today's session will be a brainstorming, interesting session. We welcome you, sir, for this session.
Thank you.
We extend our warm welcome to all the distinguished members of Pondicherry and Vellore branch and members of other branches, and also the other participants for the seminar. With heat gaining up for ITR filing seasons, members will be busy with their professional duties because of their hectic schedule and responsibilities. In spite of the same, members have taken their valuable time to participate and attend the seminar on a very, very important topic. This gives us great delight and feeling acknowledged. We wish a safe and good health to all the members. With these few words, I welcome you all for the program and requesting the Vice Chairman, CA Satish Kumar, to introduce the speaker to the participants. Welcome you all.
Thank you, sir. Good evening, one and all. I would like to introduce CA Cotha Srinivas before this session. CA Cotha S. Srinivas is a BCom graduate from Bangalore University and a fellow member of Institute of Chartered Accountants of India and also member of the Institute of Cost and Professional Accountants of India. He is partner of SSB Associates, Chartered Accountants, Bangalore. He has served the institute for over 2 decades. 2.5 years as student committee member of SICASA Bangalore branch. 9 years as management committee member of Bangalore branch of SIRC of ICI. 9 years as the regional council member of SIRC of ICI. As a student committee member, he has served a member and secretary of Students Association. During his tenure at Bangalore branch of SIRC of ICI, he has served in all positions. He was chairman of Bangalore branch during 2009 and 10. During his chairmanship, he started distributing bags to CA students, and so far, over 25,000 students have been benefited by this initiative. During this year, branch was awarded Best Branch branch of SARC. As a regional council member, he has served from 2010 to 2019. He was chairman of SARC during 17-18. CA Cotha S. Srinivas, as member of SARC, has brought in many initiatives which include conducting ARRC annual regional residential course on international taxation, and is successful in conducting 5 ARRC on international taxation. He organized a regional level interstate cricket tournament for members. He was instrumental in collecting around 1.5 crores towards CA Benevolent Fund in the year 2017-18. He conducted around 1,000 hours of CPE program at SARC during 17, a first of its kind. Organized 5 ARRC during the year 17 in southern region, covering GST, international taxation, and Indian accounting standard and corporate law. He prepared concept paper on coaching classes as chairman of academic advisory group. He was instrumental in developing digital project for SARC. Improvised IVR system for members and students is made available in 6 languages. Infrastructure development in SARC was undertaken. Presented paper at various study circle meeting, workshop, seminar, conferences on topics covering direct tax and international taxation. Visiting faculty at ICA Bangalore authorized a book named CA Referential for Chartered Accountants, which was released by Bangalore branch of ICA as study circle series booklet. Life member of Karnataka State Chartered Accountant Association, life member of Bombay Chartered Accountant Association, founder of group dynamic study group on international taxation at Bangalore and Chennai. Thank you, sir. We welcome you.
Thank you.
Over to you, sir.
Thank you, Satishan, for the question. And I also thank both the branches, the chairman Prabhakaran and also Rajshekaran of Puducherry branch and Vellore branch, and all the managing committee members and other members who have participating in this particular study circle meeting on section 195. So I will just share the screen and start with my presentation. So screen is visible, sir?
Yes, sir. Yes, sir. Visible.
Okay. So once again, welcome. So I'll be taking you through this section 195 form 15C and CP. Of course, it's not that we are talking something new topics as such. All of us are aware of this section 195 and we have been discussing this and we have been practicing in our day-to-day practices as such. And form 15C CP with the new portal coming, we are supposed to do this online, not only in the new portal, even in the earlier portal we were doing online only. But now with the new portal, still it is not completely, what do you say, for filing this form 15 CSCB. So as of now also, it's very difficult. It is becoming difficult for us to file form 15 CACB through the new portal as such. Last week, 1 or 2 forms were uploaded in our office, but I have getting messages that it is difficult to upload form 15 CA and CB through the new portal as such. Now, what we are going to discuss today will be, I'll be taking you through this introduction about this TDS provisions, stages of TDS and comparison, then general aspects of section 195, Then we have overview of section 195, which all of us are aware, form 15C and CB, and issues and probable solutions. So I would like to take maybe 1 hour and 30 minutes. Now it is 5:15. Let me try to take you through for 1 hour 30 minutes, that is 6:30 or 6:45. Then we can give some 15 minutes time for question and answer session. Will that be okay, Chairman? Chairman?
It is all right, sir.
So
Yes,
1 hour 30 minutes I'll try to complete, and then my 15 minutes we can leave for question and answer.
Yes, sir, sure, sir. Okay.
So introduction of tax deduction at source, which all of us are aware. There are four words in tax deduction at source: tax, deduction, and at source. The tax is defined under the Income Tax Act. So as per section 2, subsection 43, tax means income tax chargeable under the provisions of this act. If you get into the definition of tax under the Income Tax Act, 2 subsection 43, it covers 4 or 5 lines of definition. But the sum and substance of that particular definition is tax means income tax chargeable under the provisions of this act. Of this act means Income Tax Act 1961. Next, we have the next word, deduction, not defined under the Income Tax Act. Means if you take the general meaning of deduction, it talks about the act of taking away something from a total. That is an amount of money from whatever you are supposed to pay to a person. If you are deducting something or taking away a certain portion of that particular amount and give the balance, that act is called as deduction. So you are deducting something from the final payment that has been made to another person. Then we have at source. What do we understand by at source? Not defined in the Income Tax Act. At source means at the point of origin or issue. So at the point of origin or issue with respect to income tax or in case of accounts means under the accounting parlance, the point of origin or issue is at the point of the transaction that takes place. So it's at the point of transaction that happens. Any event, any business event that happens, which needs to be recorded in the books of accounts as a transaction, that is considered as the point of origin or issue. So at source means any transaction that takes place, any recording that you do in the books of accounts, that refers to the source or the transaction at source. So the tax has to be deducted at that particular point of time. That is when we are entering a transactions into the books of accounts. That is called as at source. So to the concept of TDS, by this time we have understood that where it will have 2 persons. One is the deductor and the deductee. So the deductor, whenever he is making the payer, you would call as a payer. When he is making payment to a deductee, that's a payee. From that particular payment, when it is at source, he has to deduct certain amount and remit on his behalf to the government. So it is something called surrogate taxation, where on behalf of the payee, the payer is deducting some amount and remitting the tax on his behalf to the central government as such. So if you see the definition of tax under the economics, so it has got the direct taxes and indirect taxes. Some of the characteristics of indirect taxes is where the burden of paying the tax can be shifted from one person to another person. Like if you see the GST taxes, where the burden of paying the tax will be shifted from one person to another person. If you take TDS, here also there is a shifting of burden of paying tax from one person to another person. So on behalf of the payee, payer is deducting the tax and remitting. So in that perspective, this TDS can also be considered as a part of an indirect tax definition. But since it is part of a direct taxes, that is income tax, it is considered as a direct tax provision. Next, we'll come to the income tax law. Income Tax Act has got this section 4, which is a charging section. 4 subsection 1 under the charging section says the central act enacts that income tax shall be charged. So it gives a power for the central government to charge tax from every person who has earned income in a previous year in the assessment year. So it gives powers for the central government to charge a person or subject a person who has earned income in a previous year to tax him in the assessment year as such. Then 4 subsection 2 talks about 4 subsection 1 says how to charge. It gives powers for the central government to charge the tax. And 4 subsection 2 talks about how to collect the tax. So collection and recovery of tax, or the modes of collection and recovery of tax. In that, the two main modes of recovery of taxes, one is deduction at source and second one is paid in advance, that is advance tax. So when you talk about collection and the modes of collection and recovery of taxes, one is in the form of tax deduction or collection at source, and the second one is in the form of advance tax payment. And for that, to address these provisions, we have a separate chapter under Income Tax Act, chapter 17, which deals with collection and recovery of taxes. So this is the structure of chapter 17, which has got various headings. Chapter 17A, which is a general heading covering section 190 and 191. Then chapter 17B, which deals with deduction at source. So usually whenever the TDS provisions comes, we would have come across this particular thing saying that chapter 17B, which deals with deduction at source. Sections covered are 192 to 206 AB. So like that, there are various headings. Finally, it ends at heading G, chapter 17G, which talks about levy of fee. And the sections covered will be 234E to 234H. So for this chapter 17, if you see the number of sections, it starts with section 190 and ends with section 234H. What is section 190? So 190 talks about deduction at source and advance payment. So section 4 subsection 2, I said the modes of collection of tax. It also said it is deduction at source and paid in advance. That is what section 190 says. So that is what section 190 talks about, deduction at source and advance payment. So I said section 4.1 says the central government will charge a person on assessee, called an assessee, for whatever income he earns in previous year, he will be subject to tax in the assessment year as such. But section 190 says even though practically, so whatever the income you earn in a previous year, you are subject to pay the tax in assessment year, but the recovery of tax will not be done in the assessment year. It will be majority of the taxes will be collected in the previous year itself. If you analyze any client as such, except very, very small clients, all the clients, those are paying income tax. So whatever the income they earn in the previous year, they discharge the tax to that extent in the previous year itself. So what are the ways of paying the tax in previous year? One is tax deduction at source. Second one is tax collection at source. And the third major thing is payment of advance tax. We know that advance tax we have to pay in 4 installments. By 15th of March, a person has to pay 100% of his tax liability. So we know as per the provisions that income earned in previous year is subject to taxation in assessment year. But in reality, whatever the tax liability that needs to be discharged in assessment year will be paid in the previous year itself. It will be recovered in the previous year by various modes, that is tax deduction at source, collection at source, and by advance payment. Apart from that, of course, when it comes to employer-employee, there may be even this 190 to 1A, which talks about taxes paid by the employer on behalf of the employee towards this non-monetary perquisites. So all these modes are there where the income earned in the previous year on that tax liability will also be recovered in the same previous year. That is what section 190 talks about. Then we have section 191, which talks about direct payment. So there may be two situations where a person is earning an income for which TDS provisions is not applicable. So there may be a person who is having an income. For all those income, he is not subject to TDS because we have certain limits under the residential tax payments. We have various limits. Beyond that limits only, we are subject to taxation. Or certain things are there where it may not be subject to TDS. Or there may be second situation where his income is liable for TDS, but the payer has not deducted the TDS. In those two cases, where first thing I said, income in respect of which tax is not required to be deducted at source, and income in respect of which tax is liable to be deducted but not deducted. In these cases, section 191 says he has to make a direct payment. So how we will make the direct payment? In the form of advance tax. So in view of the provisions of section 191, the proceedings for recovery of tax necessarily had to be taken against the assessee whose tax was liable to be deducted but not deducted. So there is where a person is earning an income on which TDS has not been done, or there is a case where he's earning an income on which TDS is required to be deducted, but the person has not deducted, then it will be the liability of the person, the assessee who receives. So tax is payable by the assessee directly. So how we will pay the directly? In the form of advance tax. He has to calculate, he has to estimate his income, that is total income. On that estimated total income, he has to estimate his tax, and that tax has to be discharged in 4 installments, that is by June, September, December, and March. So section 191 says there may be a situation where his income is subject to TDS but not done the TDS, then a department can proceed against that particular person and recover the tax from the person who receives the income. Now we'll move on to the stages of TDS and comparison. Comparison, when I say that I'm talking about TDS comparison with respect to resident payments and TDS comparison with non-resident payments. First, let us understand the stages of TDS. There are 4 stages under TDS, that is D, P, R, and C. So when I say D, P, R, and C, most of you would have understood what I am mentioning. That is D, P, R, and C. D means deduction, P means payment, then R is the returns, and C is the certificate. So these are all the 4 stages that has been involved under TDS provisions. So what is the date of deduction? So let us try to understand a bit about these things. Deduction, the date of deduction, when the particular tax has to be deducted. It says the date of deduction. So we have understood deduction at source. So we are talking about, we are referring at source. What is the date of deduction or the point of deduction? At source is credit or payment, whichever is earlier. So whenever there is a transaction that is at source, that is credit to the particular payee account or payment to the payee account, whichever is earlier. So that is the date of deduction. Then we have a mode of payment. What is the mode of payment? Once you have deducted, the next stage is to make the payment to the department. So what is the mode of payment? It is electronic payment in challan number 281. Earlier, we used to do manual payment. Of course, there are some seniors I could see in this gathering where they would have experienced how we used to file the taxes. We used to get 4 challans, 4 parts challan. So we used to fill everything and go and deposit in the bank. They used to keep two sets, and they were returning to us another 2 sets. These were all where all the things were filed physically. Now this electronic modes has come, e-payment. Most of the payments will be done through electronic media in challan number 281. Now also you can do physically, like you can generate this challan, take a printout, attach a check and give it to them, or cash. That also is possible. But majority of the payments will be done electronically. What are the due dates? Now I said deduction at source, we understood. Mode of payment electronically. What is the due dates for making a payment? Are there any due dates? Yes, there are due dates. 7th of subsequent month and 30th of April. So whatever deductions you make from month of April to February, that should be deposited or remitted within 7th of subsequent month. So whatever, now we are in August, whatever the deductions that you have done in August before 7th of September, we have to remit the TDS, except in the month of March. For the month of March, they have given certain leverage where it has to be deposited by 30th of April. Then coming to the returns, the third stage is returns. What is the periodicity of filing these returns? What is the form that needs to be used? It is quarterly in form 27Q. So this, hello. I think others should mute themselves, Chairman. Hello, is it audible now? Yeah. So the periodicity and form is quarterly. It has to be filed the returns, and it should be filed in form 27Q. What are the due dates for filing these returns? So 31st of July, 31st of October, January, and 31st of May. So at the end of every quarter, so first quarter is April to June. From there, 30 days. That is the end of that particular month. That is 31st of July. Then the second quarter ends on September, so 31st of October. And the third quarter on December, 31st of January. Fourth quarter, even though it ends on March, but the due date for making the payment of TDS is 30th of April. From there, again, we have one more month, that is 31st of May. So these are the due dates for filing the returns of TDS. Then comes this certificate, the last stage in this, to issue certificate to the payee. Whatever the payer does, all these three things, when he files the returns, he has to generate a certificate and issue that. The due dates is 15th August, 15th November, 15th February, and 15th June. So whatever the due date is given here, from this particular due date, within 15 days, he has to issue certificate. And the form is Form 16A has to be used for issuing this particular certificate as such. Now we understood these four stages: deduction, payment, returns, and certificate, and we have understood what needs to be done. Now let us understand what happens if I don't do what I'm supposed to do. So first thing is I have to deduct. What happens if I don't deduct? So if the assessee is not deducted the TDS as such, so what is the consequence? First one is disallowance of expenditure under section 40A1. So this I'm talking about now. Whatever I'm talking is with respect to non-resident payment, because we are talking about TDS under section 195. So when I say section 40A1, this is with respect to non-resident payments alone. 40A1 is with respect to resident payments. So if you are not deducted, there will be disallowance of expenditure under section 40A1 and penalty under section 271C. What is the quantum of penalty? The amount of tax you are supposed to deduct equal to that amount will be the penalty under 271C. Now the next situation is he has deducted, but first stage he has completed deduction, but second stage payment he has not made. Deducted, not paid. What happens? Even in this case, deducted, not paid, disallowance of expenditure will continue. And along with penalty, maybe even prosecution under section 276B will be there, which may be ranging from 3 months to 7 years. Next, he has deducted. It is not that he has not paid, but there is a delay in the payment made to the government. So there will be interest under section 201. So 201 gives us the interest rates for delay in payment. So from the date of deduction to the date of deduction, it will be 1%. From the date deducted to the rate of payment, 1.5% for every month or part of a month. Then the next stage is return. So a person has deducted and also remitted, but he has not filed the returns. What happens? Not filed the returns, penalty under section 271H. So there may be a penalty that can be levied under 271H, which ranges from 10,000 to 1 lakh rupees. Delay in filing. So next situation is, it is not that he has not filed, but there is a delay in filing the returns. Fee under section 234F. There will be a fee that needs to be charged under section 234F, which all of you are aware. That's 200 rupees per day of delay. The last stage is, after completing all the first 3 stages, the last one is he has to issue the certificate. What happens if I don't issue a certificate? If the payer, the deductor, is not issuing the certificate, is there any penalty? Yes, penalty under section 272A. So for the delay in issuing the certificates, from the date he is supposed to issue the certificate till the date he has issued, whatever the delay is there after the due date, every day there will be a penalty of rupees 100. So these are some of the things where last slide we saw what a person has to do. The next slide, the present slide, we are seeing what will happen if he is not doing what he is supposed to do. Now, if you analyze these 4 stages, deduction, payment, returns, and certificate, which the deductor has to do, the first 2 stages, what he is supposed to do is with respect to the government. That is, he has to deduct and make the remittance. So if he deducts and makes the payment, there won't be any disallowance of expenditure. But when it comes to the next 2 stages, that is returns and certificate, this stages is with respect to the payee. That is, the person on whose behalf is deducting the TDS. So what happens if the director deduction makes the payment? These are expenditure will be allowed. But if he is not filing the returns for the payee, he will not get tax credit. That is whatever we call as Form 26A in the resident payments. If you are not filing the return for the TDS or statement of TDS, then the recipient, that is the payee, will not get the tax credit. And if you don't issue the certificate, he cannot claim. But now because of this technology, where if you have filed the returns, that will go and sit in his 26A. So it's not that the certificate is required for all the situations as such. Even if you are not issued the certificate, but if you file the returns, that will be sufficient. But whenever you are filing the TDS returns, you make it a habit that you generate the certificate and send it to the payee as such. So the first two stages is with respect to the government that he has to do, and the next two stages is with respect to payee. Now let us see some of the comparisons between similarities. First, let me take the similarities between resident TDS and non-resident TDS. The first similarity is date of deduction. Of course, this is same in both. When I'm talking about similarity, so it is same in both the situations. The resident TDS credit of payment whichever is earlier, non-resident TDS credit of payment whichever is earlier. So this is a general rule, both under residents and non-resident. But here also there are certain situations or certain sections where it is exempted. Means it is not on credit or payment, it's only on payment basis. When it comes to resident TDS. Similarly, there are few situations, even when you are making payment to a non-resident, it will not be on credit or payment whichever is earlier, it will be on payment basis only. Date for remittance, we understood that it is 7th of subsequent month and 30th of April, which holds good for both the resident TDS and non-resident TDS. Date of returns also is same, the 4 dates. Dates for certificates also continues to be the same thing, that is 15th August, November, February, and 15th. And all these dates I'm telling you as per the Income Tax Act 1961, wherever it is there, or income tax rules as such. Now, because of pandemic, there will be changes in the dates. I'm not talking about those dates. What is there in the system, that is in the provisions, that is Income Tax Act and income tax rules, I'm referring to that. So then maybe you may say that, sir, these particular dates for this quarter has been extended, the next quarter has been extended. So that you may have to go through that. What I am saying is as per the law. Then nil or lower certificate can be applied both under for the resident payments and also non-resident TDS payments. For resident payments, it can be applied by payee under section 197. But when it comes to non-resident TDS, it can be applied by payee both under section 195(3) and 197 as such. Assessee not in default if payee does certain activity. So there is a concept called assessee in default, where a person is supposed to deduct TDS and remit that to the government. If he has not deducted, or after deducting, he has not remitted, or not deducted and remitted, he'll be considered as assessee in default. So there is a situation where payee does certain activity. The person who is supposed to deduct TDS, even though he is not deducted TDS, he will not be considered as assessee in default. What has to be done by the payee? The 3 things he has to do. One is he has to consider that particular income in his total income when he is doing the computation, and he has to pay the relevant taxes, and he has to file his return of income. So if the payee does all these things, even when payer has not deducted TDS, where he is supposed to deduct TDS but not deducted TDS, then he will not be considered as assessee in default. So assessee not in default. So these provisions, earlier it was applicable only for resident TDS payments. Now it is applicable even for non-resident TDS payments. Then PAN. So resident has to give PAN or Aadhaar. When it comes to non-resident, he has to give PAN. Gross amount. So it's also same. TDS to be done on gross amount, both under resident TDS and non-resident TDS payments. TDS has to be done on gross amount. When I talk about gross amounts, I am excluding the other taxes like GST and other taxes. I am excluding that. The balance, whatever you are supposed to make the payment on, that I'm considering as gross amount. Now let us see some of the differences between resident TDS and non-resident TDS. TDS rates. So in TDS rates, when it comes to resident TDS, it is being specified in the respective sections. So most of the TDS rates will be, if you see the sections, most of the sections, it will specify the rates that has to be used for deducting TDS. But when it comes to non-resident TDS, it doesn't specify the rates. It talks about rates or rates in force. And this I'm referring to section 195. Non-resident payments to under section 195, it won't specify any rates. It talks about at rates or rates in force. Limits. So there are limits specified in each and every section. Say if you take 194C, there is a limit. 194I, there is a limit. For all these resident TDS payments, there are certain limits specified. Under section 195, no limits are specified and it is taxable from rupee 1. The type of deduction, it's considered as tax deduction at source. When it comes to non-resident payments, it is considered as withholding of taxes. So if I have to tell you one difference between tax deduction at source and withholding of tax, in fact, both are same. The characteristics of this, both words, phrase is same. Tax deduction at source and withholding of tax means the characteristics is same. That is, whenever the payer is making a payment, he is deducting a sum towards the tax and remitting to the government. So what is the difference between tax deduction at source and withholding of tax? Tax deduction at source, when we are making towards resident TDS, we deduct on as per the specified rates given in the respective section as such. So suppose 194J, a client is making payment to a chartered accountant for the professional services, you will deduct 10%. But that particular chartered accountant, he may pay tax at 20% and 30%. But the person, the payee will deduct at 10% because 194J says 10% TDS. But when it comes to non-resident TDS, we talk about withholding of tax. Withholding of tax, when it comes to non-resident, usually we withhold the entire tax liability. Under TDS, whatever I said 194J, what we deduct the tax, it is not his ultimate liability or final liability as such. But when it comes to non-resident TDS, always in most of the cases, we deduct his entire liability. So that is what the word phraseology may be there as withholding of tax is only tax deduction at source. Surcharge and cess. So when in case of resident TDS, only specified TDS rate is deductible. That is whatever the rates that has been specified in the section, that is the one at the rate at which we apply and deduct the TDS. But when it comes to non-resident payments, we have to add surcharge and cess to be added to withholding taxation. So whenever you are deducting TDS under section 195, applying the income tax rates, we may have to add surcharge and cess, because I said we are actually withholding the entire tax liability of from the non-resident. So the tax liability for non-resident includes surcharge and cess, and this surcharge and cess to be added only when you are calculating the rate as per the Income Tax Act, not as per the DTA rate. So if you are deducting TDS under section 195, applying DTA rate, then the DTA rate includes surcharge and cess. So there is no need for you to add surcharge and cess for DTA rate. But when it comes to income tax rate, you may have to add surcharge and applicable cess for that. Nil or lower certificate, payer can't apply for the certificate. Under section under resident TDS, the payer, that is the person who is making the payment, the deductor, he cannot apply for lower deduction or nil deduction as such. But when it comes to non-resident TDS, even payer can apply. So we saw that payee can apply under section 197. Under 195, even payer can apply for lower deduction. The information. So payer need not furnish any other information. For resident TDS, he need not furnish any other information. Of course, he has to do that stages, deduction, payment, filing of the returns and issuing of the certificate. Those stages he has to do. He need not furnish additional information. When it comes to non-resident TDS, payer need to furnish information. What is that information? Is what we talk about section form 15CA and 15CB, where the payer has to provide additional information in the form of form 15CA and 15CB. Disallowance. As I said earlier, resident TDS 40A 1A is the disallowance section, where if the person who has not deducted TDS or deducted but not remitted, disallowance at the rate of 30%. So if you have made a payment of 1 lakh to a resident person for which TDS are supposed to be done, you are not done. On that 1,30,000, that is 30,000 will be disallowed. But when it comes to non-resident payments, so disallowance will be equal to 100%. So 1 lakh is the expenditure on which TDS is supposed to be done. If you are not done that, then entire 1 lakh will be as a disallowance. So under resident payments, it will be 30% disallowance. When it comes to non-resident payments, it will be 100% disallowance. For other legislations, anything to be referred for resident TDS, no need to refer other legislations to go through this Income Tax Act 1961. That will be sufficient. Of course, if you have to refer some related things like income tax rules, you have to refer the circulars, notifications, case laws, that is different. But you can be within the purview of Income Tax Act. But when it comes to non-resident TDS, you need to refer double taxation avoidance agreement and sometimes even this FEMA regulations for doing TDS under section for a non-resident under section 195. So these are all the differences between resident TDS payment and non-resident TDS payment. Now we'll move on to this general aspects of section 195. What is the applicability? I have just divided this with a particular heading, and let me try to explain to you this one. And when I am explaining these things, I'll be almost covering the section 195. So overview of section 195, I'll not spend much time. I will just take you through that particular provisions. So applicability. So basically, this particular provisions in the section 195 is applicable to a non-resident not being a company or to a foreign company. So whenever the recipient is a non-resident, section 195 will be applicable. When the recipient is a resident, section 195 will not apply. The other sections which are there. Actually, under the TDS, I told you, chapter 17B deals with tax deduction at source, which covers from section 192. So 192 to almost 206 sections are there. So 38 types of deductions are there for TDS. And the TDS provisions, we have almost 38 types of deductions. So deductible. So on what this particular TDS has to be done? On interest payments. So one is on interest. Whenever there is an interest payment made by government or a resident or a non-resident to a non-resident, then TDS has to be done under section 195 or any other sum chargeable under this act. So anything chargeable under the provisions of Income Tax Act is subject to TDS under section 195. What is chargeable under the provisions of Income Tax Act? Of course, we should refer section 4, the charging section. Then we should get into section 5, which deals with the scope of total income. Then section 6 deals with the residential status. So whenever you are dealing with a person, we have to apply the section 6 and see whether he's a resident or non-resident. Then we have section 9, which talks about income deemed to accrue or arise in India. So when you take section 5, the different types of income received or deemed to be received, income accrued or arising in India, or deemed to accrue or arise in India, all these things are taxable in a non-resident. So whatever income that a non-resident earns in India is subject to tax in the for that particular non-resident. So any sum chargeable under this act. So section 9, after section 9, you may have to get into section 14, which gives us the heads of income. Income from salary, income from house property, income from business or profession, and capital gains, other sources. So if the non-resident has got any income under any of these heads, and if it is earned in India, then it will be subject to taxation. So if any person making payment to a non-resident, that particular income is chargeable under the provisions of Income Tax Act, he is supposed to do TDS. What are the rates? I said at rates in force. Rates or rates in force is defined as section 2, subsection 37. With respect to section 195, it is 237, 3A. I think 2A or 3A. No, in the future slides, I'll tell you the exact section. What is rates or rates in force means? You have to compare the income tax rates, that is the Finance Act. Every Finance Act will give us the advanced tax rates. So when you take the Finance Act, The first schedule, Part A, Part B, and Part C are there. Part A, which gives the current year's income tax rates. Part B gives us the TDS rate, and Part C will give us the advanced tax rate. That is the tax that is applicable for the next assessment year. So the rates or rates in force means whatever the rates that has been prescribed in the Finance Act or the double taxation avoidance agreement rate. So double taxation avoidance agreement also, as you know, each and every article will give us certain rates. So the rates or rates in force means at the option of the assessee, whichever is beneficial to the assessee. The Finance Act rate or DTA rate, whichever is lower, that is called as rates or rates in force. The limits, already I said, there is no limits prescribed. TDS starts from ₹1. Payer status. So the government, resident and non-resident. So when I'm talking about payer status, when the payment is made by the government, when the payment is made by the resident, and when a payment is made by the non-resident. So you may wonder how that non-resident making payment to another non-resident, how these TDS provisions will be applicable. I'll explain to you that. So the payer status, whenever the government is making payment, resident is making payment and non-resident is making payment. So resident making payment to non-resident, generally it is taxable. Exceptionally, resident making payment to non-resident is exempted. Non-resident making payment to non-resident is exempted. Exceptionally, it is taxable. So the payee status, non-resident at the time of deduction. I'll explain that what I said now after completing this payee status. So payee status means it should be a non-resident, as I told you earlier. Any payment made to a non-resident, section 195 is applicable. So when you have to determine the status of a particular person, usually when we file the return of income at the end of the previous year in the assessment year, we will find out the residential status of that particular person. But this during the year when you are deducting or making a payment to a person, at that particular point of time, you have to determine whether it's a resident or non-resident. How to determine at that particular point of time? Based on his previous records, you have to see whether that particular person is a resident or non-resident at the time of deduction. So that is sufficient with respect to the deductor. If he determines the residential status of a recipient at the time of deduction, that will be sufficient. This thing, the compliance that has been done by the deductor as such. Now I was talking about the previous thing where resident making payment to a non-resident, generally it is taxable in the hands of non-resident, but exceptionally it is exempted. That is resident making payment to a non-resident. So this deals with three types of income, that is interest payments, fees for technical services and royalty, which is covered under discussed in section 915, 916 and 917 as such. So if resident is making payment to a non-resident, either as an interest or royalty or fees for technical services, and these services are utilized by the resident outside India. So we should understand, if a resident is making payment to a non-resident towards interest, royalty and fees for technical services, and the services of that particular non-resident is utilized outside India for setting up a business or profession, then that particular income paid by resident to non-resident in the hands of non-resident are considered as income deemed to accrue or arise in India, and that is not subject to taxation because it is not considered as income in India. Now, non-resident making payment to non-resident, I said generally it is exempted, but exceptionally it is taxable. What is that exception? So let us take the, we have to consider the same three types of payment, that is interest and royalty and fees for technical services. If one non-resident is making payment to another non-resident that is outside India towards interest, royalty or fees for technical services, then it will be exempted. But by exception, it will be taxable. What is that exception? If that non-resident who is making payment to another non-resident using these resources or services for a business or profession set up in India, then for the person who receives, the other non-resident who receives, for him, it will be considered as income deemed to accrue or arise in India, and person has to deduct TDS on that particular non-resident and remit to the government as such. So deduction already I have said at the time of payment or credit, whichever is earlier. Basis of deduction also I have said TDS is done on gross amount paid or payable excluding the taxes, other taxes. Lower deduction, payee can apply for nil or lower deduction of tax in section 195(3) and 197. So there are two sections where the payee can apply for nil or lower deduction. One under section 195(3) and the other one at section 197, where the resident payees will apply under section 197. Even non-residents can apply under section 197. Payer to apply. So I said in case of non-resident payments, even the payer, that is the resident payer or non-resident payer, whoever it may be, he can apply for nil or lower reduction of tax in section 152, which is the circumstances where payer will apply for nil or lower deduction. So if the payer feels that whatever amount is that he is paying to the payee, that is the non-resident, the entire sum is not subject to tax in the hands of non-resident in India. Say for example, if I have to give an example, say a person is a resident, he is making payment to a non-resident who is selling his capital assets in India. Say he is selling his immobile property in India. The owner of that particular property is a non-resident. The resident is making payment to a non-resident. Now, he is transferring the sale consideration. So we know that sale consideration is not his income. So he can claim certain exemptions, like whatever the expenses that he incurs out of net sale consideration, he can reduce the cost of acquisition of that asset and cost of improvement of that asset, depending upon the type of asset. He can, if it is a long-term asset, he can index and take the deduction. The net will be his capital gains. Now, when a resident is making payment to a non-resident towards purchase of an immobile property, the TDS he has to do on the gross amount, that is on the sale consideration. But the payer knows this entire sale consideration is not his income. So he can apply to the department saying that, see, this is the transactions which I am doing, and he is eligible for all these deductions, and his net income is the actual capital gains. So only I would like to deduct TDS on the capital gains. For that, he cannot decide on his own. He has to apply to the department and get a certificate. And accordingly, if the department feels there is no tax liability, it will give nil TDS rates. And if it feels there is a lower TDS required, then it will give a certificate for lower deduction of tax under section 195(2). Then exemptions. Salary income is chargeable under section 192 and not under section 195. So I said that any person who is a non-resident, if payment is made to him, he should be subject to TDS under section 195. There's one exception, that if he is receiving income in the form of salary, then section 195 will not be applicable. Again, it will be covered under section 192 itself. Person responsible, the person who makes payment to the non-resident. So persons we know defined under section 2, subsection 31. If it is an individual, individual is responsible. If it is a firm. In case of company, apart from company, even the principal officer of company will be the person responsible for paying the TDS. Then in certain cases, even the authorized dealers means who are the bankers that they remit taxes out of, means they remit funds out of India to the non-resident. They are also considered as persons responsible for deduction of tax at source with respect to non-residents. PE declaration. So there is something called permanent establishment declaration. Whenever you are making payment to a non-resident, you have to obtain a no permanent establishment declaration, so that we can know that he doesn't have any permanent establishment in India, so he is still a non-resident. Then TRC. So TRC means from which country is a non-resident. Tax residency certificate or form 10F to be obtained. So we have around 200 countries, so we should know the non-resident belongs to which country, and it's not just to which country he belongs. He is a tax resident of which country. So tax residency certificate or form 10F to be obtained from the non-resident, so that whenever you have to apply or to enter DTA, so this I can say TRC is a key to enter the DTA between India and that particular country. There is an agreement between those countries. Without TRC, a non-resident cannot take the benefit of double taxation avoidance agreement. Then we have something called POEM in case of companies where is the place of effective management in case of foreign companies, that also we have to take. So there may be foreign companies which foreign companies are defined as or defined as non-residents. So only if you take the definition of residential status with respect to companies, all Indian companies are residents and foreign companies are considered as non-residents. But there is something, the amendment in section 6, subsection 4 years back, there was an amendment which talks about place of effective management in case of foreign company. So if there is a foreign company and it has got a place of effective management in India, then that will be considered as a resident company. So that we have to take a declaration from the companies. Business profits. If non-resident has no permanent establishment in India, then business profit is not taxable in India. So when we take an OP declaration and when we decide that particular nature of payment is as business profits, and if they don't have a P in India, then that particular income, what you make payment to the non-resident is not subject to TDS. Make available clause, there is something called make available clause with respect to technical services and software royalty services. Check for make available clause in double taxation avoidance agreements. So whenever in case of technical services, they are not made available the entire knowledge. So the make available clause deals with making available the knowledge. If they are not making available the knowledge, only they are giving certain services where the recipient doesn't have more knowledge about the services, then there is a clause called make available. If the technology is not made available to the recipient, then it is not considered as fees for technical services. It will be still considered as a business profit. Then if it is a business profit, we know if that particular non-resident doesn't have P in India, then that will not be subject to taxation in India. Then secondment, like when the multinational companies where they have a presence in more than one country, particular project, they keep sending the employees from one country to another country that they deploy. So employees assigned to India for a particular project. So for a particular project, if you have certain experts who are working in some other nation or some other country where they have implemented that particular project, if they require their services are required, they will be sent to India and they will be using their services. So that is called as secondment. Apportionments depends upon the nature of payment. So there will be sometimes there will be apportionment of expenses. When I said multinational companies, they incur as a group company, they incur certain expenditures and they allocate among all their subsidiary companies. So whenever they talk about apportionments, we cannot consider how to decide, because it is an apportionment, whether it is subject to TDS or not subject to TDS, it depends upon the nature of payment. What is that nature that they are apportioning? Say if they are paying a particular software and it is considered as a royalty, and they are apportioning amount as royalty or as a software license fee to one of its subsidiary, that will be subject to TDS. So then in those cases, the subsidiary company has to do TDS in the hands of parent company itself. The same thing applies to reimbursement. So it's not that all the reimbursements are excluded or not subject to TDS. It again depends upon the nature of payment. And if there are general expenses where there is no upliftment, upliftment means they're not adding something to the actual cost of reimbursement. So if the actual cost of reimbursement is with respect to general expenses, there is no profit element added to that, then it is not subject to TDS. Otherwise, depending upon the nature of payment, even if it is in the form of reimbursement of expenses or apportionment of expenses, if it is subject to TDS, we have to deduct TDS on that. Double taxation avoidance agreements to be examined, which I already said. Cash withdrawal, section 194N is applicable even for a non-resident. If a non-resident is withdrawing cash from his own account, and if it exceeds the limits, either 20 lakhs or 1 crore, then he is also subject to TDS under section 194N. Advance payment. So whether advance payment is subject to TDS, the same applies to resident TDS. If the end payment is subject to TDS, then yes, even the advance payment is subject to TDS. Payments in kind, yes. If some chargeable to tax, then it is subject to TDS. So if there is any amount that needs to be paid, instead of paying in the mode of cash or bank transactions, if they give in kind, that particular income is subject to tax, means whether you, whatever may be the mode, whether it is through banking channels or cash or even in kind, that will be subject to TDS. So some of the important rules, Rule 28, 29B, 29BA, 37BB and 37BC, which we have to go through. Some of the forms, this form 13 is for applying for lower or nil deduction under section 197, Rule 28. 29B and 29BA, as I was telling about 195.2 and 195.3, where the payer or payee can apply. This is for 197, this is 195.2 and 195.3. So these are all the forms that needs to be used for claiming nil or lower reduction of TDS. 37BB is the information that needs to be furnished by the remitter in form 15C and 15. 15cc is the form that needs to be filed by the authorized dealer. Then 27Q, we know that is the form for filing the statement of TDS quarterly returns. Then information, this already is said to be filed by deductor in form 15CA. There are 4 parts, part A, part B, and part C and part D. So it's not that for each payment, all the 4 parts will be applicable. So either of the parts will be applicable, part A, part B, part C, or part D. So for one payment only, one of the parts will be applicable. It's not all the parts will be applicable. Then certification, nature of remittance and rate of TDS in form 15CB. So whenever we are giving form 15CA, and if you are using this part C, then this should be accompanied by certificate from a chartered accountant in form 15CB. What is that we are certifying whenever we issue form 15CB? What is that we are certifying? The 2 things that we are certifying, one is nature of remittance and rate of TDS. So whenever we issue a certificate as 15CB as a chartered accountant, 2 things we have to remember, and that's what we are certifying. One is, what is the nature of remittance? Nature of remittance, when I say, there are almost 20 to 21 types of income that has been defined on the DTA. So what is the nature of remittance? Whether it is a business profit, whether it is a shipping listing payments, or aircraft payment, or royalty, fees for technical services, dependent personal services, independent personal services. Like that, we have capital gains, other income, dividend, interest. So a lot of things are there. So that is a nature of remittance we have to mention in the certificate, and applicable rate of TDS. So whenever you are certifying the rate of TDS, nature of remittance, you should also certify the rate of TDS. So this is the nature of remittance and this is the rate of TDS. How you will arrive at the rate of TDS? If there is a double taxation avoidance agreement between that particular country and India, and he has provided TRC, through the TRC, you can enter to that DTA. You can take whatever the benefits that has been available. I said the rate of TDS will be as per the rates or rates in force. So you have to see the Finance Act rates and compare with the DTA rate, whichever is beneficial or lower, that rate has to be applied. And when income tax rate is lower, you have to apply, you have to take that rate plus add surcharge and cess. But and when you are deducting TDS under the DTA rate, there is no need for you to add surcharge and cess. We have something called LRS, that is a liberalized remittance scheme and a specified list. So remittance under LRS and specified list, no need for form 15CA. So 15CA itself is not required for these 2 type of remittance, that is remittance under liberalized remittance scheme and specified list. There are some around 33 items that has been specified. For those payments, those nature of payments, 15CA is not required. Then surcharge and cess, already I have explained. For payments to non-residents, tax to include surcharge and cess only and only if it is calculated at the income tax rate, not at the DTA rate. PAN and other compulsory to be provided, section 206A. TAN required to deduct tax. So whether deducting the TDS in the hands of non-resident, whether he has to obtain a TAN, the answer is yes, he has to obtain a TAN. Filing of ITR, certain sections exempt non-resident from filing return of income. So there are various sections, as we said. when we make payment to a non-resident, it's not the TDS that we deduct the entire withholding of taxation. So entire tax has been deducted in the hands of non-resident. So the Income Tax Act will provide certain exemptions to those non-residents from filing return of income. Foreign exchange, what is the rate that has to be employed? Like when you are making a payment, usually you have to take the date of deduction. So there is a section rule 26 and rule 115. We just go through that those two rules. Which is the date that you have to apply? What is the date you have to take, and what is the rate you have to take for converting foreign currency into Indian rupees as such? So usually it talks about SBI TT buying rate. So we have to take that and we have to apply. We have to see rule 26 and rule 115. For various types of income, various dates are there that we have to refer 115 and convert the foreign currency into Indian rupee as such. What are the punishments we have seen? Disallowance of expenditure, interest, fee, penalty, and prosecution. There is apart from this, there is penalty under section 271I. So if you are filing, we are supposed to give some information in form 15CA and 15CB. So if the deductor has failed provide this information, or he has provided inaccurate information, then there will be 1 lakh penalty under section 271I. So for the person, the deductor, if he has not filed the information properly or he has filed inaccurate information, there will be penalty for each and every default that has been made of rupees 1 lakh. So we should be more careful with respect to 195 payments. Even furnishing of information should be proper. Otherwise, they may land up in paying penalty for each and every certificate, which comes to around 1 lakh per certificate. Revised return, yes, that can be revised any number of times. No due dates required. Adjustments, any excess TDS made can be adjusted with previous year and next year. Then intimation, when you file the return of TDS within 1 year from the end of the financial year in which return is filed, as per section 200A, the department will give an intimation. Like we will get this summary assessment under section 143(1). Like that, section 200A, they will give an intimation. And if you feel that that intimation is not correct, you can file a rectification under section 154. Then appeal. So I said there will be order under section 201. Assessee in default. Section 201 talks about assessee in default, where a person is supposed to deduct TDS but not deducted, or deducted not remitted. So in all those circumstances, assessee is considered as assessee in default. If you get an order stating that a particular assessee is in default, and if you feel that it is not so, then you can go on and appeal under section 201. Assessee not in default. So I explained what are the circumstances where assessee is not considered as a default. That is, a deductor is not considered as a default. For that, there is one rule 37 BCA and form 26A. So to consider a person not in default, the payee, after doing certain activity, that is considering this income in his computation, paying the relevant taxes and filing the return of income, he has to give a certificate in form 26A. This particular certificate should be signed by a chartered accountant, practicing chartered accountant. This in the form of form 26A. You can refer rule 37 BCA, which gives all the details. Through form 26A, if he gives to the person who is supposed to deduct but not deducted, then he will not be considered as assessee in default. Then rounding off, TDS amount to be rounded off to nearest rupees 10, section 288B. Then decimal. So in returns, tax rates can't be given for more than 2 decimals. Whenever you file this 27Q or any other returns as such, where the tax rates cannot go beyond 2 decimals. So if you are calculating the tax that has to be paid to a non-resident, the basic tax plus surcharge plus cess, and if you get decimals beyond 2, you should restrict to 2 decimals. Otherwise, we cannot file the TDS returns. Non-filers of ITR for section 216AB, which has been recently introduced, applies to those non-residents who have PE in India. So it will not apply to all those all the non-residents. It applies, 216AB applies only to those non-residents who have permanent establishment in India. Then they'll be considered as specified person, provided they have not filed the return of income for last 2 years. DSC, whether it is required for Form 15CA, not compulsory, but for Form 15CB compulsory. That is 15CB to be issued by a chartered accountant. So for all chartered accountants who are issuing Form 15CB, DSC is compulsory. UDIN, don't forget to generate this UDIN. UDIN to be generated and upload in IT portal. So whenever we issue a Form 15CB, we have to generate UDIN number, and that has to be uploaded in the IT portal. Other sections which covers this non-resident payments, excluding section 195, or these are some of the sections where under these sections, if any payment is made to a non-resident, these sections are applicable. 194, B, 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 E, all these sections will be applicable for non-resident payments. Now, having understood that, what do you call this, general aspects of section 195, where I would have covered a majority of the things, let me quickly run through this overview of section 195. So section 195 has got 7 subsections. 195.1 talks about scope and conditions for applicability. 195.2, I said who that the payer can apply for lower withholding of taxation. 195.3, I said the payee can apply for nil or nil withholding of taxation certificate. 195.4 and 5 are procedures, like what is the validity period of the certificate, then who can apply that particular, which non-resident can apply for nil deduction or lower deduction of TDS. Then 195.6 talks about payer shall furnish information. That is information, again, that practically section Form 15C and 15CB has to be provided by the non-resident, means the deductor, the payer. Then 195.7 says assessing officer to determine appropriate proportion of sum chargeable to tax. So 195.1, if I quickly run through this. So any person, so it says any person responsible for paying to a non-resident, not being a company, or to a foreign company. So when we say any person, we know defined in section 2, subsection 31. The 7 types of persons are there, which has been defined. And person responsible, already I spoke earlier, person responsible is defined in section 204. Whenever it is the person who is remitting, he himself is responsible. Say, suppose individual is making payment to a non-resident, he is the person responsible for paying. If it is a firm, HUF, like that. Company means company and principal officer. And when it comes to certain payments, like where a non-resident has invested in a foreign exchange asset, using a foreign currency, he has invested in foreign exchange asset. And if he has transferred that foreign exchange asset and it is a long-term capital gains, he gets long-term capital gains, then the authorized representative, authorized dealer, the bankers who remits that particular proceeds to the non-resident, he will be considered as person responsible for paying. So it has to be paid to a non-resident, not being a company or to a foreign company. How to non-resident? When to determine a non-resident? I said at the time of the transaction, that is payment or paid, whichever is earlier. How to determine whether a particular person is a non-resident? We may have to refer section 6, which gives how to determine a person whether is a resident or non-resident. In case of individual and HUF, we know that for residents, there are 2 more bifurcations. That is resident and ordinary resident, and resident but not ordinary resident. So when we talk about non-resident, section 2, subsection 30 defines non-resident. It says non-resident means a person who is not a resident. So resident is defined under section 6, and non-resident 2, subsection 30 says any person who is not a resident is a non-resident. And further it says for certain sections, it includes, non-resident includes resident but not ordinary resident. So there are 3 sections, I think 92, section 168, and one more section is there. But section 195 is not covered in that definition. So when we are talking about section 195, resident but not ordinary resident individual or HF will not be considered as a non-resident. They will still be considered as residents for section 195. So what is that we need to make payment to the non-resident? this already I explained. Any interest not being interest referred to in these sections, because these are specific sections where any interest paid under these sections will not be covered under section 195. It will be specifically covered under this 194 LB, LC, and LD, or any other sum chargeable under the provisions of this act. So any other sum chargeable, I said you have to see section 4, then get into section 5, that is scope of total income, then go to section 9, which deals with income deemed to accrue or rise in India, and section 14, we know the heads of income. So all those heads of income will be subject to taxation, except not being income chargeable under the head salary. So if any payment is made to a non-resident in the form of salaries, that will not be covered under section 195, it will be covered under section 192 itself. Shall at the time of credit or such income to the account of the payee, this we have understood, like it is similar to the non-resident payments. At the time of credit means, even if you are making an entry that is payable entry to the particular person that is a non-resident, or even as a suspense account entry, if you make an entry, if you can identify that particular payment is to be made to a non-resident, then that is sufficient to say at the time of credit. Or you are not crediting, you are not making an accrual entry, directly you are making a payment. So whichever is earlier, so or at the time of payment thereof, in cash or by check, or a check or draft, or by any other mode, whichever is earlier. So either at the time of credit to the account of the payee or payment, whichever is earlier, deduct income tax thereon at the rates in force. So this is section 195(1). It says if any resident or government or non-resident is making payment to a non-resident towards interest or any such sum chargeable under the provisions of this act, shall at the time of credit or payment, whichever is earlier, shall deduct income tax thereon at the rates in force. So the rates in force, as I've explained, it's the Finance Act rate or DTA rate, whichever is beneficial to the assessee. So section 204, I said any person responsible for paying, already I've covered this, so I'll just skip this. So payments made to whom? So residential status of non-resident is determined as per test outlined in section 6. Non-resident definition 230, I said not ordinary residents. In some cases, generally payments not ordinary residents is outside the purview of section 195. So the twin conditions for attracting section 195 is from the payer perspective, credit or payment of income; from the payee perspective, some chargeable to tax in India. So whenever we see from the payer perspective, we should see at the time of the deduction and the credit or payment of income, whichever is earlier. When it comes to the payee, so if that sum is chargeable to tax, then deduction happens. Otherwise, there is no need for deducting TDS. So to just sum up this, for whom it will be applicable, payer is a resident, payee is a resident, section 195 is not applicable. Payer is payee is a non-resident. This particular thing is applicable because the payee is non-resident. Payer is a non-resident, payee is a resident, not applicable. Payer is a non-resident, payee is a non-resident, it is applicable. So whenever you see here, the payee is a non-resident, this particular section 195 is applicable. Otherwise, it is not applicable. So all the section 195 depends upon the status of the payee. If he is a non-resident, then it will be applicable. If he is a resident, it will not be applicable. And as I said earlier, even if the payment is made by resident to non-resident or non-resident to non-resident, with those exceptions, it may not be applicable. Otherwise, it will be applicable. Some chargeable under this act, as I already explained, section 9, which defines income deemed to accrue in India, and we have to analyze this tax treaty wherever India has entered into an agreement with other countries. So we have to see avoidance of double taxation, provide relief for taxes paid in other treaty countries. So whenever we are deducting TDS, we have to go through this double taxation avoidance agreement. And if there are certain reliefs that has been provided in the DTA, we can make use of that and accordingly do the TDS in the hands of non-resident. So what is the scope of total income? Section 5 deals with scope of total income. Income received or deemed to be received in India during the previous year. So it's very clear that whatever is received in India during previous year, in case of non-resident, yes, it is taxable. income accruing or arising or deemed to accrue or arise in India during the previous year. So in both these cases, income received, accrued or arising or deemed to receive or deemed to accrue or arise in India is taxable in the hands of non-residents. But if you have any income arising outside India, it is not taxable in the hands of non-residents. So whenever we have to charge certain amount in the hands of a non-resident, which is received in India only, is subject to taxation, not otherwise. Then we have this section 191, section 9, which deals with income deemed to accrue in India. There are various sections 911 to 918. It covers almost all types of heads of income. There is income from salary, house property, business or profession, capital gains, and other sources. Of course, when I share this particular material, I think you can go through this. Overview of section 195, when to deduct, this also I've explained. Actual payment or credit to the account of the pay, whichever is earlier. There is one exception. I said there are certain circumstances where it is not on credit, it's only on payment basis. So interest payable by the government or a public sector bank or a public financial institution. So if interest is paid by the government or public sector bank, that is a nationalized bank or a public financial institution, it's not on credit that TDS has to be deducted. It's only on the payment basis that TDS has to be deducted. Cooperative banks and foreign banks are not covered. So if the cooperative banks are deducting or crediting interest for a non-resident, they have to do TDS. But if a nationalized bank is making a provision entry of interest payable to a non-resident, then need not deduct TDS, only on payment basis they can do. So whenever we go for bank audits, if we come across a non-resident account where interest has been credited to his account, TDS need not be done. So we may say that TDS has to be done, but applying this particular exception, we should know that payment made by a nationalized bank to a non-resident will be, the TDS will be done only on payment basis, not on credit basis. So there are three categories of payments. Payments not liable to tax, either under the Income Tax Act or applying the double taxation avoidance agreement, or there may be certain payments taxable on gross basis, that is interest, royalty, and fees for technical services. And there is a third category of payments taxable on net basis, that is business income, capital gains. So I explained you capital gains, the entire sale consideration is not subject to taxation. From that we can claim the certain exempt deductions. Only capital gains is subject to taxation. When it comes to business also, the sale proceeds is not income in the hands of the recipient. From there, you can claim certain expenditures. So if there is a sale, purchase also you can claim as a deduction, and some other direct and indirect expenses that can be claimed as a deduction. So these type of payment, that is business income and capital gains, is subject to taxable on net basis. But how to determine whether as a chartered accountant I can issue a certificate stating that I know I have all the documents, this is a sale consideration, this is a purchase cost, I will calculate everything. On the balance only, I will issue a certificate stating that this is the actual tax deduction. Whether as a chartered accountant I can do, the answer is no. We cannot do as chartered accountants also. Like we cannot arrive at the income, the portion of income that is subject to taxation, and deduct the TDS or issue a certificate for that. So to do that, either the non-resident has to apply to the department, or a resident has to, that is the payer has to apply under section 195(2) and get a nil or lower deduction of TDS. Accordingly, we should issue a certificate. Then 2 subsection 37A subclause 3. That's what I was telling. Rates or rates in force, either 2 or 3. So it is 3. 237A subclause 3. It says rate or rates of income tax specified in this behalf in the Finance Act of the relevant year, or rate of income tax specified in a DTA entered into with the central government under section 70, whichever is beneficial by virtue of the provisions of section 90 subsection 2. So we have to compare these two rates as per the Income Tax Act, as per the DTA rate. When you take the income tax rate, you have to add surcharge and says that rate has to be compared with DTA rate. To just give an example, for royalty and fees for technical services, income tax rate is 10%. So the tax rate under the Income Tax Act will be 10%. if you have to add surcharge of 5% and cess of 4%, it comes to 10.92%. This 10.92% has to be compared with the DTA rate. Now, if the transaction is between India and USA, the DTA rate is 15% for royalty and fees for technical services. As per Income Tax Act, we have calculated 10.92%. That is 10% plus 5% surcharge plus 4% on that. It comes to 10.92. We are comparing with 15%. That is the DTA rate. Now, whichever is beneficial, I will take 10.92 and I will do the TDS. Now, the same transaction, not with USA, but it is with Singapore. So it will be 10.92% as per the Income Tax Act. Then when it comes to Singapore, the DTA rate will be is 10%. Now I have to compare 10.92% and 10%. So whichever is beneficial, deducted 10%. That is a DTA rate. So when I take DTA rate, that is inclusive of every other taxes, that is surcharge and cess. So I should only take that DTA rate, income tax rate, I have to add surcharge and cess, then I have to compare. Okay, so this was one proviso that was introduced, like when we say income deemed to accrue or rise in India, so there is no requirement that the non-resident should provide services in India, that is within the India. He can provide services outside India, and there is no requirement that he has to have a business or a permanent establishment, place of business or business connection in India. So all these things are not required for a non-resident to get his income subject to that is chargeable to tax. So section 9(1) says, irrespective of whether the non-resident has got a place of business in India, or he has got a residence or a business connection in India, or he has got any other presence in any manner whatsoever, whether or not, whether he has got or not. So because of technology, a non-resident sitting outside India can render certain services, whether it may be technical services, royalty services. So even though he has not come to India, he has not serviced in India, he has not have any office in India, then also certain income or income deemed to accrue as in India in the hands of the non-resident, and that will be subject to TDS. Then 195(2) I have explained that when the payer feels that there is any sum chargeable and the payer considers that the whole of such sum would not be charged, should not be income chargeable, payer may make an application. So this is what I was explaining with respect to capital gains example, where the payer can apply. It can apply under Rule 29BA using Form 15D and 15E, whichever is applicable. Under 195(3), the payee can apply under section, what is that, the Rule 29B, and using Form 15C, he can apply that. The payee can apply under section 195(3) if he wants a nil rate of TDS as such. So if I compare all these three sections, application under 195(2) is made by the payer, under 195(3) by the payee, and under 197 it will be the payee. The circumstances, part of the income is chargeable to tax. Under 195(3), no income is chargeable to tax. 197, no deduction or deduction at lower rate. So whether it is appealable, under 195(2) and 195(3), whatever you get, that's not a certificate, it's an order. And here under 197, it is a certificate. So whatever order you receive under 195(2), yes, it is appealable under section 248. 195(3) usually you will get for nil deduction. So when you apply for nil deduction and if you get an order for nil deduction, again you need not go and appeal. And 197, whatever the department decides, again you know what do you call the facility of going on an appeal on that particular certificate as such. So validity period of certificate, these are all the practical things. What is the validity of the period? In the certificate, they will give a validity. So within that particular validity, the expiry of that date, that particular certificate will be valid. After that, it will expire as such. Whether every payee, whether every non-resident can apply for nil or lower deduction, there are certain requirements under 195(5), which says he should be regularly assessed to tax in India, that non-resident. Then he should have been filing returns within the due dates and he should not have any defaults towards tax and interest, and is not subject to penalty for concealment of income. So that non-resident should not be facing any penalty provisions for concealment of income, and his value of fixed assets should exceed 50 lakhs in India, and he should be carrying on business for a period of 5 years. So each and every non-resident will not be eligible to file the nil deduction under section 195(3). So these are some of the things like where he should be having his business setup for last 5 years, and he should have some asset criteria. So these are some of the criteria where he'll be eligible to claim or file the application for nil rate of TDS under 195(3). So 195(6) is the information that needs to be provided by the payer. There are 15 CA, 15 CB, and 15 CC. 15 CA is information to be uploaded. 15 CB, certificate from a chartered accountant wherever it is required. 15 CC is a statement from authorized dealer. So the authorized dealer, that's the bankers who will be getting this particular certification and information and will be remitting to the foreign country. Every quarterly, they have to file a statement with the income tax department. That is in form 15 CC. Then there is some provisions called grossing up of taxation. Grossing up if tax borne by parent. So whenever certain circumstances it so happens that the non-resident says, I'm not worried about your tax structures. I am not worried about your tax structures. I don't want your tax structures. So whatever the amount that I have raised a bill, say suppose I have raised a bill for $10,000, you pay me that $10,000. Whatever the tax liability in your country, you bear that particular thing. So 10,000 I have made a invoice, $10,000 you make me the payment. Now applying the TDS provisions, the non-resident, the person the services, assume he has to deduct 10%. So he cannot pay 10,000 to the non-resident. He has to pay 9,000 to the non-resident. But non-resident says, I am not worried about your tax structures or your tax liability in your country. That you take care. So you pay me when I billed 10,000, you pay me 10,000. So in those cases, there is an option where you can gross up the taxes. Whatever the tax that grossing up of taxation under section 195A. So if you are making payment of $10,000, after deduction, it would have been 9,000. The 10% deduction, you're supposed to make $9,000. Now in this grossing up of taxation, this 10,000 is considered as 90%. So that has to be grossed up. So you should consider 10,000 as 90%. If you gross up to 100%, it will come to 11,111 or something like that. On that, if you apply 10%, 1,111 and net will be 10,000. In those cases, 10,000 you should make payment to the non-resident. 1,111 that whatever that comes, that is US dollars, that converted into Indian rupees, you have to make payment to the government as such. So this is the concept of grossing up of taxation under section 195A. Then disallowance already we have seen. Then 206 AA, obtaining of PAN. So there are, we know, which applies to a resident TDS payment, also applies to non-resident TDS payment. So the rates are rates in force or at the rate of 20% higher of the above. So if the non-resident is not making, is not giving a PAN number, so either of these rates, whichever is higher, will be chargeable to tax. The same thing applies to section 206 AB also, where if the non-resident having permanent establishment in India, he will be considered as a specified person. And if he has not filed the return of income at twice the rate of rates in force or at the rate of 5%, whichever is higher of the above. Then these are some of the sections I said. These are the sections. This is the nature of payments and the rate of tax. This also you can see, and I share you the presentations. Then overview of the tax rates. So these are the various tax rates which has been given in our this thing under section 115A and also the Finance Act. I was talking about the Finance Act, the rates that has been given in the Finance Act and DTA. So these are all the rates that has been given in the Finance Act and under few sections. Short-term capital gains under 11A. There are three categories: non-resident, individual, other than other non-residents, other than individual, then foreign company. So these are all the tax rates. So most of it is similar rates are there, except in case if you see in other income, For non-resident individual, it is 30% and other non-resident 30%. When it comes to foreign company, it will be 40%. Then royalty and fees for technical services, it is 10%. And any income from investment, in case of non-resident individual, it will be 20%. Now, these are the tax rates. Income tax rate for royalty, FTS, the section 158, 10% plus surcharge plus cess, it comes to 10.92%. Assuming DTA rate is 10%, 206 AA rate, if the PAN is not provided, 20%. Income tax rate for business income. So for business income, in case of foreign companies, the rate of tax is 40%. On that 40%, you add surcharge and cess, it comes to 43.68%. And this I've given a table where I've presumed that DTA rate is 10% and the different scenarios. PAN to be obtained, TRC to be obtained. We have to see whether he has got a P in India or not. Then what will be the applicable tax rates if you see. If he doesn't have P in India and if he has given PAN, it will be 10%. Otherwise, if he has P in India, it will become a business income. So it will become resident. So for foreign companies, the basic rate is 40%. It comes to 43.68%. In this case, he has not obtained TRC. It's not a rate, the Indian income tax rate, where it will be 10.92%. Again, whenever he has got P in India, yes means 43%. Yes means 43%. Yes means 43%. So these rates will change. So he has not given PAN, it will be 20%. Here also he has not given PAN, it will be 20%. Then quickly coming to this Form 15CA and 15CB, Rule 37BB gives us like furnishing of information for payment to non-residents. So this is the Rule 37BB, which deals with the information that needs to be furnished. Like 195.6 says the deductor has to furnish certain information, and Rule 37BB deals with this particular provisions. What are the information that needs to be provided? It has got 8 subsections. 37BB1 talks about information Form 15CA in Part A. So under this particular thing, whenever payment made to a non-resident under Section 15CA, Part A has to be used. When you have to use Part A, when the payment to a non-resident during a previous year is less than 5 lakhs. So if it is less than 5 lakhs, that is an Indian rupee, then Part A has to be used. Then 37BB1-2 talks about information to be furnished in Form 15CA, Part B or Part C. When we have to issue Form Part B and when we have to use Part C. Part B to be used when the payment is exceeding 5 lakh rupees in the previous year to a non-resident, and he has obtained an order under 195.2 or 195.3 or a certificate under Section 197. So there is a payment exceeding 5 lakhs, and either the payer or payee has obtained a certificate or order either under any of those sections, that is 195.2, 195.3 and 197. Then Part B has to be used, because in this case already the department has decided what is the rate of taxation. So Part B can be used. So where the payer or payee, that is the resident or non-resident, they are not obtained any certificates, and if the payment towards that is more than 5 lakh, then Part C has to be utilized. So whenever you use Part C, then because in Part B, as I said, department has determined the nature of payment and the rate of TDS. So there is no need for certificate from a chartered accountant. When it comes to Part C, where it is a self-assessment. So the payee is not claiming, means he has not applied for any nil or lower deduction of TDS. Then they have to go to a chartered accountant where he will determine the nature of remittance and the rate of TDS, and he has to issue a certificate in Form 15CB. Next, information in Form 15CA, Part D. Part D means where that particular sum payable to non-resident is not subject to TDS. So that sum is not chargeable to tax under the Income Tax Act, then he has to use for Part D of Form 15CA. So for all these parts, that is Part A, Part B and Part D, certificate from chartered accountant is not required in the form of Form 15CB. Certificate is required only for Part C type of payments. So Part C type of payments, certificate is to be issued by a chartered accountant in Form 15CB. Then there are remittances from the LRS in specified list, as I explained earlier. This also is covered under 37BB3. For this, even Form 15CA is not required. When Form 15CA itself is not required, there is of Form 15CB. So independently, there cannot be a situation where I will issue only Form 15CB, there is no Form 15CA. So whenever Form 15CA is there, then only Form 15CB will come. And whenever Form 15CA Part C is applicable, then only Form 15CB will be applicable. So then sub rule 4 talks about how to file this 15CA electronically with the DSC and printout to be submitted. This electronically without DSC and printout to be submitted. So whenever this Form 15 has to be submitted, they have got two options, that the remitter either he has to submit electronically, but with the DSC or without DSC. If with the DSC means he can take a printout and submit. Without DSC means he can take a printout manually, he can sign and he can submit it. Then 37BB5, okay, this is a procedural things where it says Form 15CA can be sought by income tax authorities from authorized dealers. So whenever you file this Form 15CA and Form 15CB, wherever it is required, you have to file this to the bankers where they will remit outside. So the income tax department can cross verify or can ask for a statement or a signed 15CA can be sought from the authorized dealers. The income tax department can get those things and they can cross verify whether what they have been filed in the website and what they are releasing are one and the same. Then the sub rule 6 talks about certificate in Form 15CB to be furnished and verified electronically under DSC. So I said a chartered accountant has to compulsorily have a digital signature to file this Form 15CB. And sub rule 7 talks about Form 15CC to be submitted quarterly by authorized dealers. So authorized dealers every quarter, what is the number of Form 15CA he has received or Form 15CB he has received, what is the amount that he has remitted, what is the nature of remittance, all those things he has to file with the income tax department in Form 15CC. Then when this part ABCD will apply, it's what I've already explained. Remittance during the financial year does not exceed 5 lakhs. So part A, Form 15CB required, no. Then part B, chargeable to tax. All these three, part A, everything is chargeable to tax. Part D is not chargeable to tax. This let us understand. So this first, this you have to understand. A, B, C is chargeable to tax. D is not chargeable to tax. Next, chargeable to tax. What is the amount? Remittance is less than 5 lakhs. Form 15CA part A, 15CB not required. Then remittance during the financial year exceeds 5 lakhs and certificate has been obtained under any of these sections, 195.2, 195.3 or 197. 15CB is not required. Remittance during the financial year exceeds 5 lakhs and no certificate is obtained, then certificate has to be given by a chartered accountant in Form 15CB. Then not chargeable to tax, there is no limit. Even if it is 5 lakhs or 50 lakhs or even 5 crores, there is no limit. If you identify that this particular sum is not chargeable to tax, then there is no need for Form 15CB is not required because it is exempted, is not chargeable to tax, and you have to use Part D of 15CA. Then I said there are certain, what do you call this, specified list. Some 33 specified lists are there, and even liberalized remittance scheme. So under liberalized remittance scheme, a person can transfer up to 2.5 lakhs US dollars in a previous year. 2,50,000 US dollars. So equivalent to that amount, he can transfer out of India. And there are some specified list. So it may be towards investment, it can be towards education, it can be towards travel, it can be towards purchase of goods. So there are 33 items that has been given. So we can go through this for all these things. If it is any payment which is in a specified list, even Form 15CA is not required. Then we have Rule 37BC. So there is certain relaxation for this thing. Like I said, even the non-resident should provide a PAN number Otherwise, it will be higher rate of TDS. That is the rate or rates in force or 20%, whichever is higher. But 37 BC, it gives some exception or relaxation. So 206A is not applicable for payments to IRTDC. What is this IRTDC? If it is in the nature of interest, royalty, fees for technical services, dividend, and transfer of any capital asset. If all these things are there, so 37 BC will be applicable, rule 37 BC. Even if the non-resident has not provided the PAN, you need not apply 206 AA provisions. Then we have 37 BC2. If he has not provided PAN number, but he has to provide certain information in spite of what do you say, in lieu of that PAN number, he has to provide certain information, that is name, email ID, and contact number of the non-resident, address of the deductee of the country or specified territory, certificate of his residence, and tax identification number or unique number to identify his residential status. So the non-resident, if he provides all this information, even if he has not provided the PAN, based on this, we need not deduct TDS at a higher rate. 37 BC3, interest paid on specified fund. Now, coming to the last portion of how to file this form 15C and 15CB. As I said, as on today, still this portal is not working. So based on the literature that is available, how to use, how to follow, or what are the procedures or steps that has to be done for filing 15CA-CB, we have prepared. Practically, still it is not working. So log into, this is the steps for filing form 15CA online mode, 15CA. Log into IT portal, the remitter who is making, he has to log into the IT portal, then get into the dashboard and he has to select income tax forms, file income tax forms. Then select form 15C and click on let's get started. Then select the applicable part. So this I'm talking about only these three parts, that is A, B and D. I'm not talking about part C, because in part C, we have to get a 15CB also, that is a chart account certificate. So I'm only talking about A, B, D and fill in the details. Verify the details in the preview page and click on proceed to e-verify. E-verify the submission using DSC. So in this case, the DSC is not compulsory, as I said. So e-verification should be done. This is with respect to form 15CA. On successful e-verification, you will get a transaction ID and acknowledgement number. It will be displayed. Make a note of these numbers for future reference. A confirmation message will be sent to the registered email ID and mobile number. So all these people, the assessees, as you know, they have to key in the registered email ID and mobile numbers. So whatever this particular transaction, if it is submitted successfully, you will get information to the registered email ID and mobile number. Then this is steps for filing form 15CA part C and form 15CB online mode. So what I explained in the previous slide is form 15CA part A, part B and part D, where certificate under by a chartered accountant is not required in form 15CB. Now what I am telling you is part C and form 15CB. So first, similar to the previous method, so log into the IT portal, the remitter, first he has to log into the IT portal, then getting into the dashboard, he has to select file income tax forms. There is income tax forms, in that file income tax forms, select form 15CA and click on let's get started. Select the applicable part C you have to select, then click on assign CA. So first you have to assign CA. So the remitter has to assign CA to allocate the form 15CB to a particular CA from the list of CAs. So there will be list of CAs. So when he gets into his income tax portal, there will be various auditors. There may be a separate auditor for tax audit. There may be a separate statutory auditor. There may be a separate transfer pricing auditor. For issuing of certificates, there may be 2 or 3 auditors. So there may be, for GST, there may be a different auditors. So the list of CAs, he has to assign a CA who will be issuing form 15CB. Fill all the relevant information with attachments and click on submit to CA. So the remitter has to fill in all these details and he has to submit to CA. On successful submission, transaction ID will be displayed. Make a note of these numbers for future reference. So this is the first step. Then log into IT portal. The chartered accountant, when once he gets this information, he has to log into his IT portal, get into his dashboard, work list, pending actions, for your action. From the list, select the form 15 CB, click on accept. So pending actions, or if you go, you will select this form 15 CB, for which you have to do some action. You will accept that. Then a success message will appear. Then go back to work list. Again, you should go back to work list. From the list, select the form 15 GB and click on file form. So here, whatever the information that the remitter knows, he will fill it up and he will send it to you. The chartered accountant first should accept that. Yes, I'm the person who is accepting to file form 15 CB or issue form 15 CB. Then a success message will appear. Then go back to work list. From the list, select the form 15 CB and click on file form. So here, when you click on file form, you can do various corrections to that or modifications. Select the mode as online and click on continue. Details filled by the remitter will appear in 4 categories. Then review the details and click on verify. So you can click on that particular thing. So 4 categories means the remitter details will come, remittance, remittee details will come, taxation as per Income Tax Act will come, and taxation as per DTA will come. Whatever the remitter knows, he will key in those details. Then you may have to go through that. You have to review, and if you feel that some changes are required, you can do it. Click on preview and proceed to e-verify. After all those changes, you can proceed for e-verification. E-verify the submission using DSC. So as I said, for a chartered accountant, DSC is compulsory. So you have to e-verify using the DSC. On successful e-verification, you will get a transaction ID and acknowledgement number will be displayed. Make a note of these numbers for future reference. So before that also, show that you will generate a UDIN for this certificate. And if there is any field for keying in the UDIN, you can key in that UDIN and submit it. Then this is steps for filing form 15 CA. Okay. After that, once the CA has filed the form 15 CB, log into IT portal. Again, the remitter has to log in. First, initially, he will log in. He will assign a CA. He will submit certain details and do certain information. Then the chartered accountant has to enter in his portal, review all those things, made the corrections, and he will upload. Then again, the remitter has to get into his IT portal, go to the dashboard for your action, select accept or reject. Next to form 15 CB, upload by the CA. So when a chartered accountant uploads a form 15 CB, the person, the remitter, the person who is making a payment, he can either accept or reject form 15 CB. So for reject, provide reason. For accept, enter the remaining details in form 15 CA. So if he wants to reject that particular form 15 CB, he may have to give certain this thing is there provided. He has to give certain reasons. When he accepts that particular form 15 CB, if any remaining details in form 15 CA is to be done, he has to fill in that details, verify the details in the preview page, and click on proceed to e-verify. E-verify the submission using DSC. So this I said the remitter either using DSC or not, he can do the e-verification. On successful e-verification, transaction ID and acknowledgement number will be displayed. Make a note of these numbers for future references. And as I said, a confirmation message will be sent to the registered email ID and mobile number. Even when once a chartered accountant submits his form 15 CB, for his email ID also, registered email ID, you will get a correspondence. That is successful completion message, we will get it. So steps for filing form 15C and form 15CB offline mode. Because still the portal is not there, we are doing this offline mode. The department has recently released offline utility version 1 for filing various statutory forms. Log in the utility with the same credentials used for the IT portal. You can download the pre-filled form from the IT portal and import the same in utility. So these are all practical things which they have explained. Generate the JSON file from the utility, log into IT portal, upload the JSON file and file the form. So now since the portal is not working, offline utility also has been provided. Now portal is simply not working. So manually you have to prepare form 15 CACB and you have to sign that and we are submitting to the bankers as such. Now even DSC is not, we cannot make use of the DSC. We have to we are physically signing and issuing to the bankers as such. So common fields in Form 15C and CP, like name and address the remitter, name and address the beneficiary of the remittance, so contact information, residential status of the remitter, PAN if available, details of remittance, details of TDS, and verification of the form. So what is the nature of payment? What is the amount that you are making payment? What is the currency in which you are making the payment? Then what is the TDS rate applicable as per the Income Tax Act and as per the DTA provisions? And what is the actual TDS amount? So all these things are some of the common fields in Form 15C and 15CB. There are certain issues and probable solutions that I think I will leave this because of paucity of time. So finally, I thank both the branches, that is Pondicherry branch and the Vellore branch, for giving me this opportunity to share a few of my thoughts with few of the interested participants who have been with me for past 1.5 hours as such. Now we can take few questions for next 10-15 minutes and we can wind up. Thank you once again to all of you for giving me patient listening.
Thank you, sir. Thank you, sir. And there are a few questions in the chat box, sir.
Yeah, if you can read out, I can answer.
Yes, sir. It is available to you also, sir. I'll read out now, sir. Membership fee paid by Indian Logistic Company to International Logistics Organization, which is in China, don't have PE in India. Whether TDS under Section 195 is applicable on that fee? If so, at what rate? This is by Mr. C.A. Rafiq.
Yeah, but whatever that membership fees and all has been paid, so that is not in the nature of remittance we have to see. It's not under any of the nature where it is subject to TDS or it is not subject to tax in India. So it can be something like a, what do you call this, business income. When they don't have P in India, it will not be subject to TDS.
Thank you, sir. And there is another query from CAV Thomas. What advice can be given to NRIs plan to return to India but hard to go back due to COVID-19 situation?
So we cannot give suggestions for them. But of course, last year there was some circular where because of non-availability of travel modes, people were forced to stay in India. For them, there was certain when during that lockdown period. Last year, it was a lockdown period was only in the month of March for 5 days. From after 25th, the lockdown started. Many people they got a exemption or some notification for that. But for 2021, that is from 1st of April to almost May, June, July, many countries there was some restrictions for travel.
Yeah.
So of that, still we don't have any clarifications or circular that has been received by the government.
Okay.
So there we cannot do anything. Like one of my client has come and he is in India. Now he became resident and we are taxing him on his global income for 2021.
Yes. And this is a question from CA Mohan Subramaniam. Banks pay interest on FDs from the actual date of deposit, say quarterly, while some other banks pay interest on FDs for every quarter ending June, September, December, and March. In the latter case, it is easy to obtain the TDS particulars and the certificate, while in the former case, interest income earned at year end is not available for the purpose of filing tax returns. How to address this issue?
No, it is for TDS or for taking that interest amount you're asking. Just repeat that question, sir. I was thinking something else.
Yeah, this is also available for your view also, sir. I'll once again repeat.
Yeah, please.
You can also see.
Can just read out. Okay.
Yeah, some banks pay interest on FDs from the actual date of deposit, say quarterly, while some other banks pay interest on FDs for every quarter ending June, September, December, and March. In the latter case, it is easy to obtain the TDS particulars and certificate, while in former case, interest income earned at year end is not available for the purpose of filing tax returns. How to address this issue?
So usually what we do is, because what happens, even in resident cases also, this in under with SBI FDs, we are facing a lot of problems. So what we have decided, let us go as per Form 26AS. Because what happens, there will be interest accrued as per their statements, but in Form 26AS, it will not be showing. Next year, it will come in Form 26AS. So it will be difficult for us to have a control of what we have charged last year, whether to have a reconciliation statements as it, because every year, new articles will be handling those cases. So we have gone on basis of 26 years. And if you can calculate certain interest on accrual basis, you can do it. But this being income from other sources, even we can go on receipt basis. It need not be always on accrual basis as such.
Yes, sir.
So for membership fee remittance, the bank insists for Form 15 CB, whether we have to issue Form 15 CB by stating not applicable of TDS. Yeah. Practically, the bankers insist for 15 CB for every remittance, because they have got a checklist to have Form 15 CA, 15 CB. They don't know whether 15 CB is required for this. Even for the other cases, what I said, Form 15 CA Part A, B, and D also, they may ask for certificates. Even for liberalized remittance scheme, they will ask. Even for what do you call this repatriation, that is from one person transferring from his one bank account, Indian bank account, to his foreign bank account, certificate will be asked. Or from NRO to NRE account of the same person, it will be asked. So whenever they ask for certificate, definitely you kindly issue the certificates, and Form 15 CA should be used. That is, Part C has to be used. Otherwise, 15 CB cannot be linked. So when bankers insist, and if your your client also says, because bankers are issue the certificate, kindly issue the certificate. But two things or three things I should say. One is to generate UDIN for every certificate you issue. First thing. Second thing, to raise a bill for every certificate you issue. The third thing is to collect the fees after raising the bill.
Yes, sir. Sir, what is the interplay between liberalized remittance scheme and 15D? There are cases, cases identical to 15D and LRS scheme. In those cases,
it may not be identical. Maybe what you are talking about, that specified list 33 is there.
yeah,
The liberalized remittance scheme, some identification will be there. Part B, it will not be identical.
okay.
See, it's a payment made to a non-resident, like say business profit, where they don't have a P in India, it's not subject to taxation. So that is not covered under liberalized remittance scheme. That will be like what you call this Part D. There is some reimbursement of expenses where it's not subject to taxation. So then you need not, that will be covered under Part D. So any sum not chargeable to tax under the provisions of Income Tax Act will be covered as under Part D of 15C, not chargeable to tax.
Okay. So, thank you, sir.
This liberalized remittance scheme and specified list is not all income. It's not income.
Okay.
So here what we are talking about, income not chargeable to tax.
Okay.
So I hope there are no more questions. We can.
Yeah, yes, sir.
Any other questions, sir?
Members, if there are questions, please unmute and put forth your question to the speaker. Or if you have any questions, you can please raise your hand. I don't think there is any other question, sir.
Okay.
Yes, sir. Once again, thank you, sir, for your wonderful presentation, sir. It was really, you have covered all the things in a nutshell. So, and I think members would have got a fair idea about this section. Thank you, sir. I am now over to Bangalore branch chairman, C. Rajshekharan, sir, for vote of thanks.
Thank you, Prabhakaran, sir.
Yeah.
Good evening to all. Respected speaker, CA Cotha, S. Srinivas, sir, chairman of Puducherry branch, CAV Prabhakaran, sir, and all our professional colleagues. As a chairman of Vellore branch, I am very much proud to present vote of thanks on this occasion. At the outset, I would like to thank our speaker, CA S. Srinivas, sir, for his exceptional presentation. and he excellently enlightened us about the TDS provisions for section 195 and filing of forms 15CA and 15CB in respect of foreign remittances. I would also like to thank the chairman of the Puducherry branch, CA P. Prabhakaran, for organizing this very practically relevant seminar at this difficult pandemic time. I also wish to thank all our participants for participating in large numbers, and also for the patient hearing and active participation. Thank you all.
Thank you,
Thank
sir.
you, sir.
Thank you, sir. Thank you, sir.
sir. Happy Janmashtami to all.
Yeah, same to you all.
Thank you, sir. Thank you.
Okay, sir. Thank you. I'll share this presentation. Maybe you can share with all the participants, sir.
Sure, sir. Thank you, sir. It will
Thank
be-
you. Thank you.
Thank you, sir.